we have discovered that most people do not fully understand how these retirement income sources actually work, which leads to poor planning decisions and missed opportunities. That's exactly why we are making the video today, to give you a complete understanding of CPP, OAS, RRSPs, RRSPs in just 9 minutes, how each program provides retirement income, and what you need to know to optimize all three for your retirement security. Let's get right into it. Normal retirement age is age 65. And for 2025, the maximum CPP benefit is $1,433 per month, or $17,196 annually. Now, this number is increased annually for inflation. It is adjusted for inflation on an annual basis, and it is guaranteed for the rest of your life. You can start collecting CPP as young as age 60, but your benefit would be reduced by 7.2% per year, or 35% is the difference between age 65 and 60. Or you could defer collecting CPP to age 70, and there is a deferral bonus, 8.4% per year, or 42% is the difference between the age of 65 and age 70. We have posted another video on which explains in detail the calculations and why we believe it's a mistake to be trying to collect CPP as young as possible. So if you are in good health, you should definitely be not try to collect CPP prior to the age of 65, and possibly consider deferring even further. While CPP is based on contributions, as we said earlier, OAS, all its security, is purely based on residency. So anybody who has Canadian residency, 40 years of Canadian residency after the age of 18 will qualify for 100% OAS. So it is a social benefit, and this is the benefit, this is the retirement benefit that some retirees are worried about, and rightly so, because OAS comes from general revenue. And as we all know about, it's more than 10 years ago now, the government did tweak with OAS when the eligible age was increased to age 67, and then it was brought back down to 65. So currently it is age 65 when retirees qualify for audit security. You cannot start collecting audit security prior to the age of 65. And the maximum audit security at age 65 for 2025 is $727.67, or $8,732 annually. And just like CPP, OAS is adjusted for inflation. So this number will be increased on an annual basis for the rest of your life. And similar to CPP, if you were to defer OAS, there is a deferral bonus, slightly lower than CPP, 7.2%. But if you were to defer OAS to age 70, your lifetime benefit would be increased by about 37% or so. The last thing I will mention to make things more complicated, audit security is an income-tested benefit, meaning if a retiree's income is over a certain threshold, your OAS would actually be clawed back. So in 2025, the threshold is about $94,000. If your taxable income is over $94,000 in 2025, your 2026 OAS would be clawed back. Let's briefly talk about RRSPs and RRSPs. A lot of people are confused about how RRSPs work. But to simplify, you love your RRSPs when you're contributing, when you're making contributions, because every dollar that goes into your RRSP is fully tax deductible, meaning your taxable income is reduced by the amount of contributions to your RRSPs. Now, when the funds are invested inside your RRSP, think of an RRSP as a basket, and you could hold many, many different investments inside that basket. And it doesn't really matter what type of an investment you hold inside, because RRSPs are growing on a tax-deferred basis, meaning you are not taxed on any investment gains while those investments are inside your RRSPs. But once you start pulling out of that RRSP, every dollar is fully taxable. So a lot of people are confused where they think that they put an investment into the RRSP, and when they will accrue some capital gains. When they pull out, they're thinking maybe there will only be a 50% tax. Well, that is wrong. Every dollar withdrawn from an RRSP will be fully taxable. The other misconception is that there is really no difference between an RRSP and a RIF as far as taxation. So whether you're pulling a fund out of an RRSP or whether you're pulling funds out of a RIF, those funds are 100% fully taxable. But generally, while you're working, you are in a higher tax bracket than in retirement. So that is the advantage. The last thing I will say is the last difference between RSP and a RIF is that RSP you can make contributions into, or you can pull funds out of. Once you convert an RSP into a RIF, the biggest difference is that you cannot put money into a RIF anymore, and you must make withdrawals. And the latest you can convert an RSP to a RIF is age 71. You could convert prior, but the latest is age 71. As far as the portfolio or the funds or the investments that you're holding in an RSP versus a RIF, it could be exactly the same. So you don't have to change your portfolio. Portfolio could stay the same if you wanted to. Understanding each retirement income source individually is important, but knowing how they work together is even more important in order for you to be as tax efficient as possible and to be able to maximize all of your retirement benefits. How do you successfully implement a coordinated 3-pillar retirement strategy? Well, start by estimating your expected benefits from CPP and OAS based on your contributions and residency history. Then calculate how much additional income you will need from RSPs to maintain your desired retirement lifestyle. Next step would be to plan optimal timing and sequencing of each income source for tax efficiency. And you should be working with professionals to model different scenarios and confirm your retirement income objectives. Now that you understand how CPP, OAS, and RSPs work together to create optimal Canadian retirement plan, you can make more informed decisions about maximizing each pillar for your own retirement securities. If you want help creating comprehensive strategy for your own specific situation, please click on the link in the description below to watch our free video